we've seen these little bursts of upside volatility in small caps, but they haven't had staying power. And the question is, if you really do get rate cuts 100, 150, maybe even 200 basis points over the next 12 months, small caps should like that. Small caps do have a lot more floating rate debt on their balance sheet. They have much higher debt levels overall, which just means that lower rates really do help the small cap trade. But there's one huge caveat there. It's that it's not just lower rates you need, you also need resilient growth. And as I mentioned earlier, we are getting signs that growth is hanging in. But if you were to get some bad labor data or other data that would point to weakening growth, that could be a challenge for the small cap trade. One last point is that you have a huge acceleration in small cap earnings that's already baked in. They're expected to grow earnings by 35% next year. That might be too high of a bar in order for those small caps to deliver.
Yeah, earnings definitely needs to support that story. What about financials and regional banks? Obviously, with the latest move, the Fed wants banks to expand lending. They want for banks to, for their balance sheets to remain healthy. That's what the move is. Do you think that this drop in rates supports that? And do you like financials at this point in time?
Yeah, it's not just the drop in rates, it's the reinversion of the yield curve, which really does help those regional banks, helps with their profitability, helps with their eagerness to lend. And if you think about why the Fed went 50 basis points, part of it was because of some very weak commentary coming out of the Fed's beige book. Narrative commentary, anecdotal evidence suggesting that small businesses were struggling. Small businesses tend to lend money from smaller banks, which just suggests that if they can get access, smaller businesses, to cheaper capital, more access to capital, that could support small business growth, small business sentiment, which is very important for the employment picture within the U.S. So when we translate that to banks, this environment of a steepening yield curve typically is supportive of financials overall. Financials tend to outperform coming out of the first Fed rate cut, which just suggests that because they've been underperformers in the beginning of the year, there's likely still some catch-up trade to happen that is positive for the financials overall.